I'm Josh Stein. I'm a managing director at DFJ and one of the investors and board members at Box. Also on the board of Sugar CRM and a couple of other SaaS companies. I'm delighted to have 4 of the best, most talented, intelligent, good-looking SaaS investors up here. We've got one hell of a panel for you. Let me start by asking each of the guys just briefly introduce themselves, and why don't you just say your name, where you're from, and talk about a couple of the companies you work with, past and present.
Do you want us to use that or just?
Oh yeah, so you can use this too.
Don't have to. They're recording it. Okay, so Doug Pepper, I'm a general partner at Interwest, where I've been an investor for the last 11 years. We are investors in a number of software as a service companies. We were the first investors in Marketo in the marketing automation space. We're investors in Veroli, which is in the outbound notification space, and also have investments in Get Satisfaction, and a new investment that was actually closed yesterday in the social media management space called Spreadfast down in Austin. So we have a number of companies. We're investors in CubeTree that was sold to SuccessFactors. So like the rest of these guys, we have a keen focus on the disruption that's taking place in the enterprise with new software paradigms, and I wish I was an investor in Box.
Doug, where do you put yourself on the early, mid, late stage spectrum?
Generally early stage. So we were as I said, investors in Marketo when it was an idea. We do primarily Series A's, but we'll do the occasional Series B and Series C investment as well. But for us, that's more the exception than the rule. So early.
I'm Rory O'Driscoll. I'm with Scale Venture Partners. I've been with Scale or its predecessor since 1993, which is in itself depressing. I think this is a great structure for the panel because normally in the course of talking you have to pimp your companies, but now we can just pimp them up front and get it over with. So great to actually talk about the companies we're involved with. You invest in a lot of SaaS companies. We're involved in Omniture and on the board of Omniture, which went public and then sold to Adobe. And big shout out to Dana, who was the audit committee chair there and kept us out of trouble. We're an investor in Box. Glad to follow you and pay you what at the time looked like an exorbitant markup, but feels pretty good right now. And I'm also involved in Exact Target. We're on Ring Central and a number of other companies, but now and kind of exited, including Placeware, which way back when was one of the first, were you guys? Yeah, way back when was one of the first SaaS, too many to win and too old to care. One of the first SaaS companies competing against WebEx and came in a solid number 2. In terms of stage, we're actually kind of in the middle. We like early in revenue technology companies that are looking to scale, hence the Scale name. So we're not the pre-revenue, figure out the product you have. On the other hand, we're probably not as late as, say, George over there. So we've actually worked with most of the folks here, and it tends to shape out that way. First money in, someone like you or you, and then maybe a later stage, someone like George.
Great. So Byron Deeter with Bessemer Venture Partners. Cross Stage is a fund, so we think of it really as $50,000 to $50 million checks. We love working early stage with seed entrepreneurs all the way up to expansion stage. If we weren't visionary enough to invest in a company early on but still think there's a chance to make a venture return, we'll certainly look for expansion stage opportunities as well. As a firm, we're global. We manage a few $1 billion and have been quite active in the cloud space for over a decade. I first worked with the firm about 12 years ago as founding CEO of a SaaS business called Trigo Technologies. We built that up. We're fortunate to have a very nice exit sell to IBM and got to know Bessemer through that side of the table, so to speak, and came over here about 7 years ago to lead our cloud efforts. We've built up a portfolio of several dozen leading cloud companies, have been thrilled to work with some of the more recent exits in the space or IPOs, going back to Cornerstone On Demand earlier this year, which went public. Worked closely with Meritech on that, as well as Broadsoft, actually, another one last year, which went public, which has some cloud elements. LinkedIn this year, which most people, if you read the S1, you'd see about a third of that business is a pretty heavyweight enterprise SaaS business under the covers, which is pretty exciting. Eloqua, which just filed to go public, as well as a number of later stage private companies like a Twilio or an Intact, companies of that sort as well.
And my name's George Bischroff. I'm a partner at Meritech Capital Partners. We're a late stage firm, so we tend to get in very late, pay the highest prices, and make these guys feel really good about their investment. Fortunately, we've had a good run, and we've been able to get into some of the better names out there. On the SaaS side, we invested in Salesforce.com, NetSuite, Cornerstone On Demand with Byron, and certainly Box. We've found that investing in mid-20-year-old entrepreneurs who realize that going back to college later on is a good thing for them has been good for us as well. We're also an investor in Facebook. We have 4 funds and about $2.5 billion under management.
Yes, you're so modest that you forgot to mention you're on the Midas list.
Well, I think half the people on this.
Well, let's see. Let me kick things off. So and we have sort of what I'd say 2 relatively later stage investors in George and Rory, and 2 earlier, and Byron. You sort of go across the whole territory. At the early stage, let me maybe address this to Doug and Byron. What are you guys looking for? What do you see as either, when teams come in and pitch you, are there certain markets within SaaS or cloud that catch your fancy right now? Are there, elements of the pitch or the business which catch your eye? What are the things that get you excited these days?
Well, I think this is a little bit of motherhood and apple pie, but almost with any investment, whether it's SaaS or any sector, we first start with the team. And when it comes to SaaS, we look for a team that's very product-oriented, a team that has proven in their past that they can build extraordinary products. And in SaaS in particular, products that are easy to use, easy to adopt, and can be adopted by the users of the product within an enterprise. And so really reduce the friction. And so first and foremost, a team that's proven that they can do that in their past and references that way. We also look for a team, notwithstanding some of the benefits that we can get today of low friction sales. There's still a very big sales and marketing component to the companies that we're all invested in, and a team that has the capabilities to hire and manage a high-performance sales organization is something we like to see as well, even at the early stage. So those are some of the factors on the team side that we look for. And then I'd say, before I pass it over to Byron, would be, are they focusing on a very large market, but entering that market by addressing a very specific point of pain, not trying to solve all problems out of the gates, but start with a very simple piece of software that can be adopted and really have a high ROI and kill a point of pain. Obviously, we want to see that bigger vision of how can this broaden out beyond one vertical or one specific use case. But to begin with, we like to see a product that really addresses something that's a core problem. And to the extent that they've been able to build something and get it out there, we don't expect revenue that's substantial early on. But if there's some very early validation of market adoption, we like to see that as well.
So agree with all that in the sense of team, TAM in terms of addressable market, low-cost distribution. We're big fans of the consumerization of software, distribution models, et cetera. But I would also say it's a fantastic time to be an entrepreneur right now because valuations are through the roof. Your infrastructure costs are riding all these cost curves as the big boys are forward pricing with billion-dollar checkbooks. Your infrastructure as a service layers. And from our side, that means these deals are being priced to perfection, and you have to assume a lot of things work out, which means we're also looking for the wow factor in terms of really that market-changing, world-dominating potential. That, one, it's a lot more fun to work on those types of projects, and the reality is qualitatively you need to want to work with us, and we need to be excited to work with you because these are usually multi-year journeys. And the other thing is we want to feel like we're tackling something massive to have that kind of change the world potential. And that's what got us excited about LinkedIn with the network dynamics, or something like Skype when we seeded them, or Twilio now in the platform as a service world, changing telecom, or Cornerstone, a true horizontal, which I'm sure you guys early with Box thought that as well, the ability to go truly horizontal and literally have the potential to sell to every business out there. And those types of things are exciting from our view. Investing early stage, you can still pay a very nice price that feels crazy by any rational multiple of any number, and yet believe you can make a venture return on that if the potential is large enough.
I'm just going to hand it to Rory.
You just gotta. I mean, so basically, we want a very focused product that's also huge, a team that's done it before that's also 25, and we'd like it to be cheap but willing to pay a little, which is good. At least we're given on some things. I mean, I think the problem with the list is we can tend to rank we want everything, okay, and we want it cheap, right? Which is useful and interesting, but not actually actionable, especially today. So, I mean, it's interesting taking the team and market thing. Try and take a different twist on the market, because we're talking about SaaS. As I always say, it's a business model, and it's an interesting business model, but I think the number one thing is, what market are you going after, separate from SaaS? Because you can have a great business model in SaaS and a great distribution model and a great team, but if you're going after a crappy market where there's not budget, right, it's all in vain, right? So I think, when we look at the SaaS deals we've seen that have worked and not worked, that's kind of one of the basic aha moments, which is, even before the team, even before all the nuances of what you can build it before, is there money changing hands here? For example, I think some of the verticals early on just didn't have budget, didn't have compelling budget for the problem. I mean, you could have a great SaaS solution right now. We saw it 2 years ago for managing real estate sales. I think not. There are no real estate sales, so no one's going to automate a business process that doesn't actually matter, right? So I always say, kind of just starting even with that, first and foremost, SaaS is not a marketplace. No one buys a SaaS. You can't, right? You actually exist in a marketplace for a specific product or service, and SaaS is a business model and a computer architecture to deliver it. So I think the number one thing is start in an exciting place. Just take that as a start. That's good.
Yeah, it's a great point, and I think what we tend to like to see is the potential for a very vast footprint, but to Doug's point, kind of some focus around solving a pain point, showing some repeatability, that they're getting traction in the marketplace around that, and that the sales model is working, and then extend off of that base. And hopefully, it's a very hard problem to solve, but if you don't extend, somebody's going to catch you from behind, and that's one of the reasons why late stage capital exists, right? People need to continue to develop on the sales side and on the product side.
In terms of an early stage, one of the things that seems to me is that what you'll see for a Series A deal would be very different than it was 5 years ago, or certainly 10 years ago. How do you think about when a company is ready to go raise their first round of institutional funding? And what do you think, what do you think they should look like heading in, and what do you think they should aim to aspire to be heading out of the Series A?
Yeah, I mean, I think it's a good question, and as with everything, it depends. Depending on the quality of the team, and to Rory's point, the near-term attractiveness of the market, how much money is available now. I mean, you look at companies like Vitru and Buddy, where there's just a tremendous amount of capital, cash available, and budget available. Not all markets are created equal. And so, we've seen a variety of different Series A type investments. When we invested in Marketo, again, it was 3 people and an idea, and that was largely not a line of code. And still do that today? Yeah, with the right team and the right concept, and largely that was because that was an overlooked market. Eloqua was out there, but largely most VCs had decided that marketing automation wasn't going to work. And so in certain markets, I think if you have that vision and believe in what the team's doing, we'll invest. And that was a Series A. Gave them a lot of resources to go and build a product. I think that's the exception today. I think given the ability to build product and bootstrap product, I think today for a typical Series A, we would expect, as I said before, to have a team that's built either a prototype or a beta product that solves a point of pain and is out in the market either with beta customers or very early paying customers. And to me, that's the right stage for a Series A.
No, I was much more going to comment on the Marketo comment, which is it's a great point, and I think it gets to another aspect of how you think about where you can win in SaaS, right? If you think about marketing in general, in the 90s, it was probably the only department within the enterprise that wasn't automated. You know, Salesforce, I mean, the sales department had Siebel. Obviously, the financial account department had ERP. Manufacturing had, you know, supply chain management, and no one made a dime selling marketing software in the 90s. And you're right, a lot of us just said, it's done, right? And what the internet did was it created this hugely accountable culture in marketing, because for the first time, most marketing things could be tracked in terms of clicks, in terms of emails, in terms of leads, in terms of social media. So marketing went from the least quantitative, least trackable department out there to arguably one of the most trackable. And because of that, it created this huge need for a whole series of marketing business systems, right? And the interesting thing was they played very well for SaaS, because for two reasons. One, from a business model perspective, marketeers don't implement software well, and they just love buying services. It's what they're used to. They buy subscription services, so hey, software services, I'm in, right? So the model made sense. And then secondly, it really was very easy to add a lot of value in the cloud. The SaaS architecture and the SaaS business model meant for things like Marketo, which I think is a great company, in the lead management space, the leads are digital. You know, the actions that are taking place are digital. It's all happening in the cloud. Why in God's name? Exactly. That's exactly right. Why would you ever think about taking that stuff out back to the back office and doing something with it offline, right? So that was a place where a couple of things came together, this whole digital marketing space. One is it created a need for the product and a high ROI, because the internet marketing had good return on investment and therefore money flowed. And then secondly, SaaS had a big competitive advantage versus the on-premises stuff in terms of being a better solution for it. And if you step back, not just from Marketo, but there's a whole series of companies that are really taking, I'd say about a third of the SaaS companies out there are really automating various parts of marketing. I mean, you have Salesforce, I think, dominates sales, and there ain't a lot of oxygen left in that particular room. But someone mentioned Buddy Vitru. We're investors in Vitru, but there's a whole bunch of companies in social media marketing. There's web analytics, there's Marketo, and there's Eloqua, which are, you know, the two winners in the kind of B2B marketing automation. There's Responses and Exact Target. So there's probably going to be 20 companies that make money in a big picture automating the marketing process, where in the 1990s nothing happened. And that to me illustrates the point of step back and say, the things that are going to happen are the things that should happen based on the timing and the market need. And, you know, I think you guys did a great job seeding that one early.
So the only thing I'd add in terms of how to make this actionable for entrepreneurs in the room thinking about when do you raise, how do you raise for that early investment is this macro point. You can get very far with very little today. And so if you drop yourself into an attractive market, as Rory says, where you've got these dynamics of a rising tide, you've already got the cloud tailwind, which is the major growth sector within software, you can get very far on seed capital, friends and family money, drop into one of these incubators, what have you. But you can actually get to product, to customers, to get real market feedback, et cetera, on $1 million. Whereas, you know, when I founded a SaaS business in '99, we were 10 plus million into it with, you know, Sun boxes and Oracle licenses and, you know, 6
angry
months of
VCs and scared VCs.
And half our equity had been given up because venture's dilutive when you have nothing to show. Yeah. Venture's, you know, dilutive at all points. It's a high cost of capital. And so get as far as you can with as little as you can so that you use the venture money to get into that hyper growth, because it's a good proposition for the entrepreneur and for us. If you are funding, you know, real actionable investments in you know, specific areas, and capital is fairly cheap right now in that early stage, so use it as you can. Sometimes we'll even participate in something like a Twilio, where we actually gave them a small seed check, participated in a convertible note, and said, you know, go figure it out and let us know how we did, and then we'll talk about a venture round, because you're not ready for the full venture round, and yet we're excited by the team and what you're trying to do. And sure enough, we essentially, you know, priced a round, then marked up our own round later for a follow-on. And so, you know, you can get those dynamics where
you can do that venture.
There's an efficient market, and it works well for all
Unfortunately,
sides.
it turns out you can't actually get paid on it. But yes, it feels good for a while.
Yeah, no, and I'd just add that we really see that dynamic Byron's mentioning on the late stage side. All throughout the 90s, early 2000s, all the deals that we would do would already have 3 or 4 rounds from marquee venture firms in the earlier rounds. And now we're seeing some real bootstrapped organizations that are late stage, but they haven't gone through those 3 rounds, and they're looking for a different type of partner. And so that's great for us. I mean, we see these really efficient businesses at a late stage that haven't taken much money. The only problem is now everybody is dabbling in late stage. So competitively, it's as tough as ever. But
Yeah, I mean, as a point of reference, Box, when we invested in the Series A, Box was just the 4 original founders, but they had tens of thousands of users and tens of thousands in monthly revenue, even at that stage, and they'd only raised hundreds of thousands of dollars previously. So even then, you get further. I would say, if we're looking at early stage SaaS companies, occasionally you find the team where you have so much conviction in the market of the team you'll make a bet, but really there's almost no excuse to not have a built product and users, I would say, before you're raising the Series A now. Let me do a quick, we're going to transition to late stage panel in a couple of minutes. Does anyone have a question they'd like to ask our group on related to early stage? Yeah.
How do you feel it seems to me, it feels like the valuations of the post-A have gotten higher and higher.
Yep.
I hate to use the word bubble, but
Okay.
how is that
We're comfortable with
impacting
that.
earlier stage, the Series A rounds? Are you, over time,
Yeah.
they tend to stay pretty flat, but is that
Are we seeing that
pressure?
drift
Yeah.
up there? What do you guys think?
Yes. We're investors, and so ultimately our economics are a function of the buy price and the sell price. And there are a lot of businesses we would love to be shareholders in that just the buy price looks too high to make that economic case to become an investor in. The extreme example, look at Salesforce.com. We're not public market investors, but of course we'd all love to be shareholders at some price. And so the debate is the valuation fair or not? And so what's happened is, as you see, the public market multiples have run up. We've got this weird discontinuity right now in late stage valuations, frankly, where they're trading at premiums to their public comps because of high growth rates. That's unusual. There used to be a discount for late stage private to their public peer group. Who knows if that returns or not? But if we're investors and we fall in love with businesses, that's the environment. And if you want to be a participant, that's the game you play. But it is absolutely rolling downstream. And so on a Series A deal, whether if the pre-money's in the single digit millions for pre-money, then that's shifting up a million or 2 or 3, which is a big percentage, but obviously on an absolute basis a smaller amount. And again, if we can convince ourselves that this can be a multi-$100-million potential outcome, then we can still sleep okay at night. But there's absolutely inflation across the board, and again, as entrepreneurs, that's goodness for you.
I agree with everything Byron said. The only thing I'd say is it's all relative, and there are certainly pockets where the valuations across all levels have gone up much more than in SaaS. So if you look at direct-to-consumer internet, I think there's even more frothiness at all stages, including Series A, than SaaS, where I think there's still a little bit more rationality.
Yeah, we'll talk about this in the late stage. I also think that you're seeing better companies now, particularly in SaaS. The companies are further along at the Series A. You have more, you have paying customers. You might even have sales metrics where you have some level of confidence. So to me, I think there's no bargains in venture. If you get into a good company early, good companies always look expensive at every point on their curve. But I think there's actually I'm encouraged as an investor. There's more data to work with earlier than versus in '99 when you'd be $10 or $20 million in before you had 3 customers.
Yes, absolutely. The quality of companies right now is outstanding. There's a tailwind in the market, so there's this buying dynamic where you've got market adoption for cloud, whereas it was a headwind 10 years ago, it's a tailwind today. And good teams that have been in enterprise software that are visionary are all moving into this direction. And so you've got that combination of really aggressive entrepreneurs with a market tailwind, and there are fantastic companies in the space right now.
Yeah, I think that's true. I mean, I agree with something you said. You said there's no bargains. I always say there's no value in venture. It's just not a value play. And if you find yourself ever doing a deal because it's cheap, you'll almost certainly lose money. It's just one of those things you learn, right? Because they're digital outcomes. A company that's doing $5 million in revenue will either get to 100 million or it won't. And if it doesn't get to 100 million, or if it tapers out in terms of growth rate, it doesn't really matter what you paid. You're going to get your money back if you got preference, and you're going to lose money if you're common. So I agree that it's not a value play. So that said, I agree. We're at the tight end of the race now between most everything in SaaS is working, right? In terms of, right. So And, you know, markets abhor a vacuum. So the more everything's working, the better, quote, things are. The only way to screw it up is price, and that's what markets do. They push it to the equilibrium point. And if the deals are great, if the deals are growing, if the deals are well run, then the only thing you can do to screw it up is price. And lo and behold, price is how it tapers out. And, you know, I think we're seeing that now. You look at a lot of these deals and you go, yeah, that assumes that they do what Salesforce does for the next 8 years, and then you'll make it 3 times your money. Maybe, maybe not, right? And that's agreed. Totally. Exactly. It's like the Wall Street saying the stock doesn't know you own it, right? They're totally disconnected. At the end of it, you can't. I mean, and this is does a lot. It can be tempting at times in venture to own a stock because it feels good to own that stock, to make that investment. But you got to make sure the fundamentals justify it. And I think there's been a little bit of that, as you see. The later you go, the higher you reach, the more you're assuming it's exceptional. And some kids are exceptional, but it's like Lake Wobegon. You know, not all the kids are above average. It just doesn't work. So that's the terror point, you know. And it's all about, you know, so, and we're all in this, you know, we're all in that marketplace, and you can't say, well, I just won't play for the next 3 years. So you end up in this dynamic of stock picking, right, which is just the way it is. I mean, to give an extreme example, the reality is the most overpriced deal of 1999 was a pre-revenue company in a crowded space where they paid 75 pre. They must have been idiots. Turned out to be Google. Awesome stock picking. 1,000 deals out there. Most of them are going to be bankrupt in 3 years. We pick Google, says Kleiner and Sequoia. You got to hand it to them. Exactly right. I remember when, George, you guys did yours at 500, and you took a lot of, oh my God, right? The higher pricing in general goes, the more the premium is on stock picking, and stock picking is really hard, right? But that's why they pay you. We won't be much hurt. Keep going. Totally.
Yeah. So I think that's actually an interesting segue. I mean, with the benefit of hindsight, I think there's always. It seems to me that there's always an inflection point in companies where it flips from being something that's sort of a theory that it's going to work, having a much higher likelihood that it works. And I think, you know, if I think back on Vox, for example, I think it was somewhere around the point where you came in, where you say, look, you know, if you just look at the underlying math of the business and the metrics, you were starting to say, I have a lot of confidence in what the future looks like. Give me some thoughts around what are the metrics that you guys think of as you, George, especially, let me start here. You know, what are the metrics that you're looking for when you're trying to do that stock picking? And when you see the companies that maybe don't make it, where do they fall off the road?
Yeah, no, it's a great question. Because we do look for all the things the early stage investors look for, which is massive market, great team, you know, technology that's hard to replicate. But then, since we are paying a higher price and have the luxury of more data at a late stage, we need to, you know, we have the benefit of a lot of data. So we certainly look at sales trajectory. I mean, to us, that speaks magnitudes in terms of is there value being delivered to customers? Can the team execute? And also, is the market timing happening right now? One of the most difficult things, I think, in late-stage investing is timing that inflection. And it's an art form, and personally, it takes a lot of luck because there are a lot of factors that you just can't predict that will come to the situation.
Metrics, and are there any one or two metrics that you think are really...
you know, we look at the bookings, ARR added, but, you know, on top of that, then we also spend a lot of time thinking about the purity of the model. And so essentially, can you profitably acquire a customer? And so on that side, you get in a little bit more of the metrics. Yeah, so lifetime value of a customer, which incorporates churn rates and gross margin. You also want to take a look at comparing that to the cost of acquiring a customer. And if you can, you know, bring on profitable customers at a multiple of what you pay to acquire them, then there's a decent business. What we found is if we go a little bit earlier, oftentimes you'll find growth, but a lot of companies spending $1.50 to acquire $1 of revenue. We see that a lot in consumer subscription services, and it's enticing because you see the growth, and I think the inclination is to want to chase the growth. That's the easy number that, you know, spits out when you see an income statement. But getting to that model is the more difficult part.
Well, yeah, we're not looking at that stage, but we have fortunately some investments that have gotten there. I think for us, what we look for is, and we talked about this a little bit beforehand. Do those metrics continue to fall in line with what you want as the company scales? So as they go from 3 to 10 to 20 to 50 salespeople, do those sales productivity metrics continue to hold? Just the customer acquisition cost to LTV ratios, do those continue to hold? If they do, then clearly spending that money in sales and marketing makes sense. I think, to me, the other thing that I really look at with our existing investments, the ones that are scaling, is I really want to understand deeply what's the user engagement, what's the customer engagement with your product. Did they not? I want to know they didn't just buy it, but are the users at that company actually every day living in that product? If you took it away, would they feel like they couldn't do their job anymore? To me, that's how you actually build a big company, because those people are going to be referring your product to their colleagues at other companies.
Qualitative or quantitative?
It's quantitative. I mean, that's the beauty of SaaS, is that we can actually see on a day-to-day basis how many people are logging in and doing their job through your product in one way or another. And it's different for every company. With Yammer, it's every employee. But
It's almost the
yeah,
consumer metrics. Really.
it's more consumer metrics.
Page view,
And so,
engagement.
right. So there's the sales metrics and the go-to-market metrics that I think are crucial. But if you don't have the foundation of those consumer metrics, as you put it, that to me indicate whether you have something that's truly sustainable and that you're not losing as many customers off the back of the truck as you're putting on the front of the truck. And in the companies I'm invested in, and to the extent we look occasionally at later stage, that's what I'm also very focused on, in addition to what George said.
Byron and Rory actually they both have personal blogs. If you haven't seen their work, their writings on SaaS you should really check it out. They've written some terrific stuff. So I'd love to hear what your guys' thoughts are on metrics and sort of what you
Yeah, I mean,
see things go on. The ones that look promising but then sort of trail off.
sure.
Common themes.
I'm going to say something to a rounding error that doesn't happen. And speaking as someone who's got it wrong a lot of times, right? If you look back objectively, the only thing I've learned is people who are going to disappoint you in the long term are the same people who are disappointing you right now. People don't change. So if I look back on the deals that we've underwritten that didn't perform as planned, I've just internalized the following statement. If I had done my damn work the way I should have and looked under the covers to the next level, all the signs are always there. Right? The guy who blows up at 100 is the guy who was already blown up at 5. Conversely, the guys who outperform early outperform forever. The way I say it is, the only reliable predictor of long-term outperformance is near-term outperformance. Right? And so you actually don't tend to see in SaaS things grown at 100% with decent unit economics and then go wrong. But the big part of that sentence that needs analysis is, what does unit economics mean? Right? I mean, I think I can never pronounce this word, Rorschach test of unit economics that's going on right now in the world today is Groupon. Everyone has a frickin' opinion. No one's seen the numbers, but really it boils down to one question. I'm not in Groupon. I know nothing about it, right? I've read the S1 cover to cover, along with, I'm sure, 100 plaintiff attorneys. And what it really boils down to is this. What is the unit economics of that business, right? 100 plaintiff unfortunately, it's part of our system. 100 plaintiff attorneys read every S1. We could I've been on the board of a public company. Any decisive action you take will result in you being sued by someone. And then you go through the problem with the interesting dynamic, and I mentioned it, is that they tried to show a different number. I don't believe the number they showed was the right one, but actually the trend to try and show a different number was a good trend. I mean, I would kill. If you wanted to know what you should do in Groupon buying, selling, or holding, right? It all boils down to the cohort analysis over time by year. And they did a cohort analysis in the Q1 2010 cohort, right? And what you need to know to own that stock is how is the cohort analysis trending over time? Because if you step back, Gap doesn't tell you everything. And it's... that's the one that you'll have on your wall a year from now. But SaaS is similar in one respect. Gap doesn't tell you the whole story, right? Because you spend money up front and you expense it and you add revenue, it only comes over time. By definition, that means that Gap can't give you the answer. It will tell you that not to buy Salesforce, it was losing money. It will tell you that when Salesforce was $2, $4, $12, $20, and at $30 to $40, they said, oh, okay, you can buy it now. Well, thanks a bunch, right? So you've got to be able to look beyond it and really understand the metrics, right? So as I say, it's ironic they're getting castigated for it, but the idea to get metrics beyond GAAP is key, right? And you were very kind to say what you said about Box and our investment. In fact, I deserve to be shot. The reality is the Box metrics were really good 9 months beforehand when I first met Box, and so foolishly turned them down and brooded on it a whole 9 months, and then looked at the numbers and saw the unit economics of sales rep productivity. And like Doug said, they kept on adding more sales reps, and the productivity didn't go down, it went up. In other words, you're applying resource to the problem and your productivity is going up. That really is all you needed to know, right? That was the sum total of my insight. So as you know, I drove down to Aaron and said, mea culpa, can I please pay up now and just do the deal? And he very kindly said yes, and we've been happy and friends ever since. But I think it does boil down to understanding how those metrics move, and they tend not to blow up in your face. The trick is to spend the time up front to see what's going on. And yes, we have a number we use, this magic number correlation of sales and marketing spend to revenue. I blog about it. It's not that smart, but it's benchmarkable. It doesn't matter what metrics you use, right? It's actionable. Is it predictive? Does it have predictive value? When we look back on our good SaaS deals and our bad SaaS deals, all the good SaaS deals, the day we did them, had compelling unit economics, and all the bad SaaS deals we did, the day we did them, didn't.
So I agree. I mean, it's hard to disagree with Rory, but but I would say we have seen. I'm not going to name names, but even in our own portfolio, and yours too, we have seen.
Especially, Joe. It's a race to Crunchbase now.
I say that because we're co-investors.
Yeah. Oh, now.
We're co-investors in one example that's in my head. We've seen great companies with great metrics hit walls, and it does happen where they can't continue to sustain the growth rate that they did in the past. And unfortunately, it's pretty hard for a SaaS company to grow quickly through 75, then 100, then 125. And the reason you know that is that there aren't that many companies that have actually done it. So I think it is hard to sustain. And where do they fall down and where do they break down? I think it's by not focusing on continuing to deliver value to the existing customer and stopping the product innovation cycle. I think these companies need to continue innovating on product if they want to continue that growth rate over time, and not everybody does that.
Yeah, so just to add to this, so agree wholeheartedly with the point that GAAP metrics don't give you the full answer, and in fact, they give you a very small portion of the answer in the cloud subscription businesses. And so when hearing this time and time again from our CEOs of, so what should I be tracking, we've put a point of view out there, and you can disagree with it. We love the debate. People do within our own portfolio. People only pull in some pieces of it. But on the Bessemer website, there's a cloud section. We've got dashboards and content, and actually have written white papers, which is the last thing a VC should be doing. But we got so many questions from our folks saying, so I get the general idea, but how do I actually implement it, that we tried to give a little more meat around it. But we've made up a term, committed monthly recurring revenue, CMRR, which is this combination of the bookings and the forward recurring revenue that George alluded to, customer acquisition cost, CAC ratio, which is what I think Doug and Rory were talking about. Rory's got a magic number element, which is very similar. There's the only real difference is a gross margin element to it. Customer lifetime value and free cash flow. Those four metrics we think give us free cash flow. A novel concept for the early stage panel. Now that we've moved to the late stage panel in the 5-year plan, we can tend to see that number turn positive.
Eventually, they have to give some money
back. And so those four metrics, oftentimes our management teams will set their entire exec team bonus plans around those numbers. Frankly, they can be too revealing, as you saw in the S1s of Cornerstone and Eloqua recently, et cetera. They back off of those when they turn public because they don't want to reveal them. Those are too insightful to reveal externally, but they are fantastically simple and transparent for the business. And from our side and from the team side, they give you a lot of that visibility into, is the flywheel working? Does it make sense to put more money into the business, to step on the gas? And if those metrics are positive, you can mathematically get a pretty good answer for the current state. Of course, you can have situations where the tailwind actually improves the metrics at scale, as Rory alluded to, or as Doug alluded to. Certainly, we've all seen businesses hit walls, and as you triple the size of the sales team, the metrics degrade meaningfully, and if you're tracking them, you at least know to back off, retune, and figure out what to do.
George, let me ask you, one thing I think we also see at the late stage is companies often, the customers they're selling to change, right? You move
Yep.
into bigger accounts, maybe even the way in which you're selling moves from something like freemium or largely self-serve into more of a traditional sales process. How do you look at that? I mean, you I think are often
Right.
seeing companies maybe when they're sort of mid-transition or even early in that transition. How do you think about the risk
Right.
there? How do you think about assessing that?
It gets back to that difficulty of understanding what the ultimate market size is. So, Isilon was a great example. It's a storage company that was selling to rich media. Essentially, video takes so much more storage capacity than what NetApp was typically used to, that it required a different architecture. And so they sold very effectively to companies like MySpace, Kodak, Easy Gallery, but that would only get the company to be so big. And of course, we were paying a late stage price. So we had to get comfortable that it was going to enter more of a mainstream market. Box, similarly, at the time we were investing in, was making a migration more towards big enterprise customers. And, the data was coming in as we were wiring the money. And so in those cases, we definitely look to customer calls as being very important and telling. And what we found in the Box case was that people were, pounding the table and saying this is an inevitable trend. Box has the security, the administration that we need on the enterprise side. One guy actually even told me that he would, quit his day job and join Box's sales force. And so we were thinking, okay, that's pretty unique. But we're looking for qualitative anecdotes like that to give us comfort that people are going to kind of cross that, chasm to a different type of customer base.
Anyone else have a thought on that?
Yeah, I think it's a great point, and it's a fact pattern. I think we're all seeing in companies is that, the trend of adoption is very organic and from the bottom up. In the case of pure freemium products, it's individual business users, and Aaron talked a lot about that, and obviously it's been interesting for us at Box. In the case of departmental type products, and I give Marketo and Eloqua, prototypical example of that, it's not an individual user product, but the small, nimble, smart people adopted it first. Like those two companies had massive market share in Silicon Valley relatively early on, but then what you see is it's interesting, the organic pull is now up, not down, right? The bigger companies are slowly getting the good stuff that the little companies have earlier, rather than the other way around, which is the little companies getting stuff the big companies already had, right? I mean, that's true for Salesforce, that's true for, Marketo, Eloqua, it's true across the board. So you get this inverted pyramid distribution model, right, which I think Box has mastered very well, which is because they cover the whole gamut. And as you know, it's complex because you got to think about a whole bunch of things. You have a free use. You have free users. Your free users will be free forever. Then you have free users who might buy a little bit of storage. You have free users who might buy a single business license, a 5-seat business license. They might be corporate customers. They might be enterprise customers. They might ultimately OEM it. So you end up with this complex business model, and at every stage, we're seeing it, we're tweaking. How do you divide up the sales force? What should mid-market guys do? How much should enterprise field sales do versus corporate telesales? How much should be free versus paid? And those dynamics are hard to manage. That's the negative statement, but they're indicative of a massively successful business model because it's organic, bottoms up, which means it's pretty hard to displace. And it's going up the pyramid, which means the dollar size gets bigger and bigger. And Mark Leslie, who I think a number of us have been on board, was a very smart guy. He was the founder and CEO of Veritas. He used to always say, you don't want to have an enterprise sales force looking for big deals. You want to be dragged into big deals by your customers. You want someone to scream, God damn it, Box, I just need an enterprise license. And then you say, oh, okay, we'll hire a sales rep. We'll do an enterprise deal. And these kind of models are just incredibly powerful in terms of their long-term duration. Complex but powerful. And I think a lot of what we're all wrestling with is how do you sort them out? You don't run that sales force like you run an enterprise Oracle sales force 10 years ago. But it's a good problem to have.
It's really changed the sales process, which I think is why you're also seeing Marketo and Eloqua more, right? I mean, it's a higher volume. You want to get customers using the product as soon as you can, ideally before you're even actively selling them.
And then we all have to buy one of these two guys' product to do the lead nurturing and just stay on top of it. So yeah, it's a really interesting process.
Go back to the audience again. Anyone else have a question they want to ask? Yeah, go ahead.
I have a quick question about how important is it that the founding team be based here?
Good question.
Don't all rush at once?
I'll,
Before
I'll,
we answer, are you based in Valley?
I am not. I am from Canada.
okay.
From
From
Ottawa, Canada.
All right.
I'll
I mean,
answer it from a late stage perspective. So at the time we're investing, things tend to be working, and so sometimes we're surprised, right? But so if we invest in the team, we like the team, and what we found is about 2/3 of our investments are actually outside of the Bay Area, because competitively, it may. If you do a deal around here, everybody knows everybody, right? And so the pricing is going to be jacked up, and so we're very open to it.
Yeah, I'd agree. I mean, you think about some of the companies that we've been talking about. I mean, Vitru is on the East Coast. Buddy Media is in New York. A company we just invested in the SaaS space is in Austin. I've got another one in Seattle. There's good teams all over the country. I think we're seeing kind of democratization of innovation around the country, and absolutely.
Country. I mean, kind of stayed up there in Minnesota.
In August, it's fine.
But Eloquo is Toronto-based.
got a Canadian deal.
Yeah.
The only thing is when you're really getting into rapid scaling, I mean, from an investor convenience standpoint, I think we're all willing to hop on a plane. Box as an example has added almost 200 people this year. I don't know that you could do that in Ottawa. I don't know that the pool of talent is broad enough that you're going to be able to find people in that quick a time frame. So I think there's Canada right there. I know. Right?
Nah.
Pow!
No, I.
It's a bigger pool of talent and resources here. It's also massively more competitive. So my guess is once you get people, you're much less likely to
Agreed.
poached away.
I agree. I think that two things on that. I think it's easier to build. I mean, we've had great success outside Silicon Valley. Omniture was in Utah and Exact Target's in Indy. As you say, Vitru's in Atlanta. But I think it's easier to build apps companies ex the Valley than deep infrastructure companies. The closer you are to needing to know what's in the Intel box and the Cisco box, the better off you are being here, because there's just critical mass of deep technical infrastructure here. Apps companies require good technical infrastructure and a lot of smart, committed people willing to work with their customers. And you can get that kind of labor pool in a number of different parts of the country and Canada, and you can actually end up with a competitive advantage there because a relatively lower cost, more loyal labor pool for business processes. So it depends by company to some extent.
As Charlie Sheen would say, winning. I mean, you just exactly. You want the Tiger Blood. You want aggressive, and you want winners. It doesn't really matter what they've done before. Just a consistent run through walls. I'm going to succeed mentality, and it goes to school or sports or clubs or activities or entrepreneurial experiences or the lemonade stand or whatever. Just people that wake up every morning saying, how do I take that hill? And
earlier point too, I'd say that the early interactions matter. So thinking about when I first met Aaron and Dylan at Box, first meeting we brainstormed some ideas, and later that night, 8 o'clock, they sent a full analysis and a deck kind of building on it.
Aaron.
And you just and Dylan too, right? And you that I remember how much that impressed me. It's just how on top of it these guys were, that they thought about, really listened and thought about what we talked about, and then they were kind of riffing on it. And I think you're right. I mean, those things matter, right? That kind of energy, that passion. Any other thoughts on that?
I mean, as these guys said, there's no cookie cutter. Every team's different, and you find things to get excited about in teams that are very different from situation to situation. I do, maybe it's old-fashioned, but I go back to what they've done before. It's not, I mean, a lot of the times entrepreneurs are young today, and they're doing fabulously well. But when I can do references on a team and hear from people that they've worked for in the past, or investors that they've spent time with, and hear things like this team is extraordinary when it comes to building fabulous product, that gets me excited. And so I do spend time looking at what they've actually accomplished in the past, because I think that's a great indicator of what they're going to do in the future.
We have a Fox founder here. If you had seen the conditions in which Sam was working, you would know how dedicated and passionate he was. That place was shit.
So when you look at traditional software companies, the go-to-market alliances with the consulting firms like Deloitte and Accenture have been a pretty big play. So how's that changing in the SaaS world? Great question.
Yeah, I think that, let's do the apps world first of all, right? Is that the reality is that implementations are dramatically different if you're using Salesforce than Siebel. The dollars aren't there. So I think the big consulting firms have struggled to find a way to make the unit economics work. Now, that's not to say there's not a need for systems integrators. I mean, Perio is out here. They're one of the new breed of systems integrators. But the amount of money that Accenture, to quote Christine Brinkley, I wouldn't get out of bed for $1 million, right? Accenture wouldn't get out of bed for $1 million, but Aperio will take the check and deliver the product, right? I think the big problem with these enormous old line SIs is the beauty of SaaS at a big picture level is more of the value has been encapsulated in the software and less of the value is therefore there for the systems integrator, right? I think they're going to have to adjust to a world where a lot of projects just don't have the same amount of revenue dollars. And they're going to, there's no, exactly, yeah. So exactly, we've handled it, like Aaron's little graphic. We've done it for you. So yeah, you still get configuration and customization revenues and implementation and training, but it's a lot less. So I think that integrators that adopt to that world can still make money. I mean, I think Salesforce has a dynamic and vibrant ecosystem. My brother runs one, Clear Task. He's always looking for business, so feel free to ping him. And there's a lot of good ones, Blue Wolf, Stadia, all that. But they're smaller startup guys. I think it'll be interesting to see how the big guys come to grips with that reality. So you see the SIs smaller. You don't see separately. You don't see the channel kind of VAR sales yet. A lot of. I mean, I think in Sugar CRM, you guys have a different experience where you have made.
Single tenant, so there is more of the installation.
Yes, you've given them more to work, but a lot. There's not nearly the amount of margin dollars for VARs and systems integrators as there were. Stepping back, big picture. You talk to any VAR, their world is ending. The margins are getting tighter, and they got to figure out what to do.
It's going to be more business process.
Yeah.
But I think one of the things that the newer SaaS companies are dealing with is, what is that company making relationship like Accenture making Siebel? And are there ways of, finding some deals that just increase your presence, right? And so, you find folks like Karen who are doing a great job in terms of getting Box pre-installed on the Motorola Zooms of the world and getting the.
But those those are very much not systems integrators.
Right, no.
It's a product world. Agreed.
Before SIs
Agreed.
were part of
Totally.
a distribution almost.
I see what you're saying.
And they would pull deals in, and now companies have to find other ways of getting the name out there, or platform partners as well.
CIO relationships,
Right.
Part of it,
Totally.
they were kind of the gatekeepers.
Exactly.
You were a new vendor, and that's not really the case anymore.
Yep, exactly.
Coming in through the side door. Let me take one last question from the audience.
That was a twist.
Going back to the discussion on metrics, you guys talked about it. I think George specifically talked about how you look at later stage companies and the metrics that you track is you're looking for that inflection point. So to the metrics that you track either publicly or as once you make the investment, as you're positioning the company for a public exit, do those change and what would be significant for those?
Yeah. So basically, the metrics are always kind of dynamic, right? It is hard to sustain some of the really strong ones as you get bigger. But the problem is, if you're not involved in these companies and you're a public market investor, you're just going to see a real narrowed down list of metrics. And that's why Rory, on his paper on Magic Number, just talks about gap ratios, even though we're all the first to admit that gap metrics don't really matter. They're not the true leading indicators, but it's kind of what you're handicapped with in terms of the deals, the information you're given on that. So, the most information you'll get as a public investor is in the S1, and then the companies are going to narrow down the list of what they provide.
I think what he's saying, I totally agree, is that when you're a public company and you give a non-GAAP metric, you're opening yourself up to a couple of things. One is they're going to ask for you forever. You can't retract it. Once you've given it, you can't retract it. And secondly, it's not clear, as you're seeing at Groupon, how do you define that metric? You now open yourself to liability around, will you define bookings this way? Are you giving a hint that it's something else? So unfortunately, most public company CFOs say, we've reached a point, you know, we're a big enough company now, we're going to give you a gap and figure it out what you will. It's just harder and harder to share more metrics, and it's totally.
0% of our board meetings use GAAP
Totally.
as the reported metric.
Absolutely.
It's not how the companies are
You're exactly right. I remember once asking them, now we do some gap revenue analysis somewhere, don't we? Right? And he said, yeah. But you're right, we haven't looked at it in 2 years. But that's the which is why you can only be public when you're at a stage where at least gap gives you a clue.
Yeah.
Early on is too hard.
All right, well, good. Well, let me close with, since we talked about stock picking before, and since we're recording this for posterity, I'm going to ask you all to dig really deep and make a prediction. So, name what you think is the most interesting SaaS company out there. Let's say less than 10 million in funding. You can't pick the obvious ones, and not one that you're involved with. Or let's say, you can pick one you're involved, because everyone likes to pimp their own companies. Not Box. Let's just stipulate.
Oh,
Box.
Jesus. Okay. It's getting harder, huh? Dude, it's yours.
So I'll pick one that
Who's going to shock the world?
well that I'm not an investor in, and it looks like I'm probably not going to be an investor in. But I'm pretty impressed with what Wildfire has done on $4 million in capital raised. You know, number of employees is not the metric we look at all, by the way. But the fact that they've been able to grow profitably to 150, 200 employees in the social media management space, marketing space, and do that on $4 million capital raised, I think is really impressive. And so somebody, I think, maybe somebody at this on this panel may be the new investor, but I think they've done some interesting things in my own portfolio. I think despite Eloqua's S1, I think Marketo's doing some amazing things.
I'll pick Okta that's here. I think single sign-on is if everything goes to the cloud, which we think it is, you're not going to type in 20 passwords, right? So someone's going to solve that problem. I think intuitively there's some interesting on-prem guys like Ping and Simplified doing that. But in my gut, I think solving it in the cloud will have advantages, both first order, it's just a cleaner implementation, and then second order, you could end up with everyone's data, everyone signing in the cloud, and just automate business processes easier. So I think it could be a little sleeper where you start with one thing and then you add more functionality over time. So I mean, I'm actively not pimping my companies. I feel so proud. I might get thrown out of the venture community. You can do it, pimp.
Well, I'll go against the guidelines first and say I'm amazed no one's mentioned Workday because they've raised a ton of cash, so opposite the model, but I think they're one of the few out there that's going to come over the top here and really rock the ecosystem as a multi-billion-dollar IPO that we all wish we were investors in. And then within the portfolio, in terms of capital efficiency, a company like Twilio, that's platform as a service, growing like a consumer business, very capital efficient, transforming a multi-hundred-billion-dollar telephony ecosystem in an Amazon Web Services like fashion. It's just exciting to watch and be a part of it.
Well, I'd say, in the above 10 million raised, excluding Box, Workday definitely seems to be in the driver's seat in terms of a massive enterprise story. But on the sub 10 million raised, I'd agree with Doug on Wildfire. We've just been really impressed with seeing a company that has gotten so much traction on just 4 million. But that's not to say that we're the new investor.
As of this precise moment in time, but when the Secretary of State is finished.
Good. Well, I'm gonna say my answer is insert your name here, and it's Josh at DFJ.
Yes. Well played. We're just a bunch of patsies for Josh.
The power of the podium.